In what some are calling Draghi's last chance, the European Central Bank has launched quantitative easing, which will pump huge amounts of cash into the eurozone economy to try to get it growing again. That money, freshly printed by the ECB, will be used to buy financial instruments called bonds, which are sold by governments and companies to raise funds. Investors buy them, lending that cash for a fixed period, at the end of which they get it back, plus interest, though that is not guaranteed. By buying bonds and getting money into the real economy, the ECB also hopes to head off deflation, which is when prices fall and the economy stagnates as people put off purchases waiting for things to get cheaper. At the moment, those bonds are sat in high street banks' vaults, waiting to mature. The ECB will buy 60 billion euros worth a month from March, with the idea that the money freed up will be lent out to households and businesses who need loans. The ECB pitched its bond buying programme on the high side, going for what some analysts called the shock and awe effect.
The size was bigger than people anticipated, but I think more importantly, it's open-ended, so they can do more if they think it's necessary. And the other thing is there's risk sharing involved. So in some ways, it's a historic announcement.
Risk sharing means the central banks of eurozone members are on the hook for 80% of the value of the bonds if their governments default and don't pay back the money promised when the bonds mature. German officials, including the finance minister Wolfgang Schäuble, aren't happy, fearing some eurozone governments now won't make essential economic reforms. The theory is that ordinary Europeans and the region's businesses will be able to get loans more easily as the banks have more cash to lend. That is what happened with quantitative easing in the United States. But so far, QE has failed to significantly boost the Japanese economy. Plans to pump out more money also push down the value of the euro against other currencies, which helps the region's exporters. But this all depends on the high street or retail banks lending on the money that they get for those bonds. If they don't do that, confidence is not restored and the ECB's plans have failed. So if the big bazooka doesn't work, then the whole single currency experiment is at risk, a massive problem for the region's leaders.